Hi, everyone. You're listening to Angel Nears, the podcast. Angel Nears is a Silicon Valley community for startup builders where experienced operators share firsthand knowledge on how to build and scale startups. I'm your host, Oleg Kujakov, and today our guest is Julian Zegelman, a venture investor and attorney who represented numerous startups from inception through multiple venture rounds. Today, we're going to talk about the nuances of fundraising for seed and Series A rounds. Before that, Julian, welcome to the show.
Thank you. Thank you so much, Oleg. Thank you for having me.
Yeah. So before we get started, I like to set up the guests, just learn a little bit more about you. I noticed going through your history that you, correct me if I'm wrong, went to the University of California, San Diego.
That is right.
Cool. Well, I was excited to talk to you because I just graduated a year ago. Actually, I was walking through the graduation stage. So we got two Tritons on the show today. Do you want to just tell me what you studied there and how your experience was at school?
Absolutely. I think it's a great school. I personally enjoyed it a lot. I studied biochemistry and political science. I entered college, like I think 90% of my entering year, believing I was going to be a pre medical student and then go on to medical school. But in the course of my 4 years there, I just realized that I was more interested in law and business, and I detoured into law school, and I never really looked back. But yes, it was definitely very interesting being there in the mid 90s as the dot-com boom was unwrapping, and there's a lot of exciting startup activity all around.
Totally. Yeah. Huge technology school. So I'm sure being there in the 90s was like really exciting. Can you tell me a little bit more about law school and then maybe what you did after?
Yeah, absolutely. So I went to law school at the University of Minnesota, so quite a change.
Yeah, you're going from San Diego to Minnesota. I don't know if it gets much polar opposite than that.
That's right. That's right. So I went to law school at the University of Minnesota, and then I went back to San Diego very briefly, and I got recruited by a Silicon Valley law firm to join their office, and that's how I got to Silicon Valley in 2007, to be exact. And I spent the first part of my career as a lawyer. Representing mostly venture capital funds, startup entrepreneurs, and tech companies, and at some point in my career, I realized there was a lot of fun building companies and helping entrepreneurs and clients build companies. And I started to get more business savvy, I feel like, and expand my network. And at a certain point, I transitioned from being just a legal advisor, so just being an attorney, which nothing wrong with that. Lawyers are needed, and there's a lot of value to a good attorney when you're running a startup. But I actually became a lot more to a lot of my clients, more of a business advisor, network connector. And at some point, I started to invest myself as an angel investor, which through a number of various ventures brought me to where I am today, where I run a boutique investment bank that actually helps tech companies raise equity and debt capital. And I continue to actively invest in early stage startups as a small fund manager and also as a personal, just a private angel investor.
Awesome. Well, today we're going to be talking about seed funding and Series A, and it sounds like you have some experience on the legal side and on the investing side. So you're probably the perfect person to talk to. Are there any, to get us started, are there any kind of rules of thumb when it comes to how much money founders should ask for when they're raising their first seed?
Yeah, definitely. It's a great question. So typically the way it works in the industry, you want to ask for 12 to 16 months worth of what's called runway, which is basically how much money do you need over the next 12 to 16 months to achieve milestones that get your business to the next level, which means for the most part allows you to show significant traction to raise the next round of venture capital, and yeah, then ultimately get to break even profitability, and then ultimately get to an exit point.
Got it. Got it. And what kind of target should you be aiming for when it comes to that valuation?
Yeah, that's a wonderful question. And I want to preface this that there's really what's called a standard range of valuations. So again, that sometimes shifts and goes up and down depending on both geography.
Mhm.
If you're raising a seed stage round of financing in, let's say, the Midwest, you're probably going to raise it at a lower valuation on average than if you're raising it in San Francisco.
Mhm.
And typically, there are acceptable ranges. So, just to give you an idea, I mean, from what I see out there, typical seed stage company outside of Silicon Valley today is probably raising money anywhere from 3.5 to 5 million pre-money valuation. Talking about seed rounds. In Silicon Valley, I mean, we saw valuations skyrocket at all stages, and so pre-COVID shutdown, we've seen seed stage valuations of 10, 12, 15, even 20 million for some of
Mhm.
the more high profile companies. I think they're going down. I feel in my book a comfortable pre-money valuation on average for a Silicon Valley startup at seed stage. We're probably talking anywhere from 5 to maybe 10 million, right, depending on traction.
Mhm. So all these companies, they have different products. They come in all different shapes and sizes, so to speak. And so their valuations are not the same. What's maybe like a sanity check for founders to check whether their funding amount and their valuation makes sense for their business?
Yeah, no, that's a wonderful question. So I think one is comparables. For example, there's a lot of good resources like Crunchbase, PitchBook.
Mhm.
TechCrunch publishes a lot. So there's definitely a lot of data,
Mhm.
as well. Silicon Valley Bank puts out like an annual venture report. So there's a lot of data out there on precise data points like what are the average valuations in 2020 in each sector in different geographies, etc. So my advice to founders is, the venture game, it's great to be unique in your product, but it's really difficult to try and pull something unique as far as how you structure the company or how you structure your round, because venture
Mhm.
capital is about de-risking, and anything that's outside the norm is automatically perceived to be risky, and you don't want to be perceived as being a square peg for a round hole or a risky venture by the way that you're structured legally or the way that you try to raise money. So, from that standpoint, I always say that a good sanity check is twofold. First, do your homework, talk to other entrepreneurs who have raised money successfully at your stage, do some research, talk to your lawyer, if they're experienced in venture financings, and just understand what is the range that is reasonable. That's kind of like the market norm for your company, your stage, and the place where you're at. That's step one. Step two, sometimes I have companies that I work with that they do that, and then they say, well, but we believe that for XYZ reason, our valuation should be higher.
Mhm.
And then, the advice I give is, well, why don't you go out there and test it on the market? Because frankly, the valuation only matters if the investor is sold in your company to a point where they may consider an investment. So fundraising is notoriously hard, and a lot of conversations end at the very first email or introduction stage. So you never really even get to the valuation discussion. Now, if you did get to valuation discussion with a couple of investors and they rejected because they felt the valuation was too high, or they came back with a counter offer, that sends you a good signal that your valuation is probably outside of the market standard. And then if you keep getting the same responses, you should probably adjust it if you want to raise the round, successfully.
Well, first off, a great thorough answer. I have a quick follow-up question. So, given that we're living in a post-coronavirus world where businesses across America are affected and hurting, but we are also seeing a bit of a tech boom. Would you expect to see those valuations go trend up or down moving forward when you're comparing it to previous evaluations?
I think what we're going to see is segmentation. And I've already seen it in the past, 2, 3 months that we were on lockdown. So
Hmm.
anything that's to either directly or indirectly benefit or, from the current situation with the pandemic. So, for example, telemedicine startups,
Hmm.
productivity, work from home startups, definitely biotechs trying to develop, more robust tests or therapeutics for COVID. I've
Hmm.
seen, I've seen deals there close in 24 hours, and I've seen valuations there skyrocket. So I think that's kind of like one subset, right? Whatever is like trending, whatever is really popular.
Hmm.
I think across other sectors, I mean, good companies with a solid traction probably not going to drop too much in terms of their valuation.
Hmm.
I think companies that were priced higher than the average and were maybe able to get away with it a few months ago just because the market overall was quite inflated. What I'm seeing now is that the deals that do close propose a discount. So I see like a 20 to 30% discount on the market for certain deals, and I think that's probably a good reflection of where the valuations are today. Should they go up? I mean, hard to say now. I would imagine with the bigger emphasis on reaching break even and being less reliant on this constant supply of venture capital. I also feel that the valuations might either freeze at the level they're at now or reach some kind of an equilibrium. I mean, I would be very surprised to see the valuations continuing to grow, because I do feel like for a certain period of time we did reach a plateau, right? Like right before the current lockdown.
Yeah, you would think. It seemed like those numbers kept growing and growing. So next, I want to talk about blockers. What fundamental issues can prevent a startup from raising capital?
Hopefully this is not like and I'll be hopefully this is sort of like not too sarcastic, but the biggest blocker is having a company that nobody wants to invest in. So for example, a business model that's inherently not a venture capital business model. I mean, that's a blocker, right?
Mm-hmm.
I still see some of those companies on the market where a company that could be a great lifestyle business, or it could be a great, professional services, or kind of like a consulting gig that may, very well grow to be a business in the, millions of dollars a year over time, but it's not venture, fundable because it lacks the fundamental scalability aspect for a venture, venture type company. I still see some people, some entrepreneurs going out and trying to raise venture capital for it. So pushing that very obvious one, let's assume that it's a tech company that is venture fundable. In principle, what could be some of the specific blockers? One blocker is lack of a clear legal structure and lack of ownership of IP. So that happens, still happens. I mean, there were numerous, countless seminars and articles and I think trainings and fireside chat that are being done, but still, I still see companies like that that either fail to secure their intellectual property rights, or there is a messed up capital structure, or there is a dispute among the founders, or another common one is a company trying to raise money so they can either buy out a non-active founder, or they're trying to raise money to secure the rights to IP. So anything that's sort of like complicated at the get-go is probably not going to get funded, because again, venture capital is about de-risking, right? It's not so much, it's about taking calculated risk and then
Hmm.
trying to consciously and methodically reduce that risk as the business plan is executed.
Got it. So those kind of big fundamental red flags, like a problem you're seeing with management or leadership or a cap table, those kind of rigid structures that are hard to change, those will raise red flags for you.
Yeah, absolutely. Because again, the venture capital game is also about opportunity cost, right? So,
Mhm.
especially for early stage investors, typically, the name of the game is to be active and spread your bets, across a wide enough portfolio so that you have the chance of, hitting a couple of unicorns along the way. And it just the model doesn't work if you have complicated, highly risky opportunities that from the get-go require a lot of handholding. So, for example, trying to resolve complicated capital structure or trying to buy out a partner or trying to secure IP rights and launch a new venture. I mean, I'm
Mhm.
not saying that those never get funded, but they're not for the typical everyday venture angel investor. And so often those kind of opportunities just don't get the traction because they cannot raise the money from the get go.
Yeah, I mean, I hear you say that, and my head says opportunity cost right away.
Right, exactly, exactly. It's opportunity cost. Another one is actually some companies that operate in an inherently limited market. And here, the thing that I found the most surprising when I to invest, and it really took me a couple of years, and some of the first exits that came in from that early part of the portfolio to understand that the more experienced venture investors were right. So, to a typical serial angel investor or to a typical early stage VC fund, if you're operating in a market where the total size of the market that you can capture within a few years, so within let's say 3 to 5 years, is less than 300 million, not a venture fundable opportunity to a VC fund. And that to me seemed to be, pretty counterintuitive at first. I thought, what's wrong with building a company that could capture, a $30 million a year market? I mean, or like a $5 million a year market. I mean, that's still like a good company, right? You can still sell it. And
Mhm.
and then I started to understand why is some of my early investments resulted in the exits, and the exits were pretty small. And at that time, they failed to cover the overall money that I invested. I realized that you got to play big, and by playing big, a typical venture portfolio goes like that: 10 investments made, five of them typically fail. The other five, you're lucky to have three positive exit events within like the lifetime of the fund, and then for you to return the fund and deliver the type of positive return to your investors, to your LPs, that allow you to make money and also to go raise a subsequent fund, you got to have at least one of those three exits be a huge blockbuster. Something close to $1 billion or at least a few $100 million in exit value. So you need one of those 30x, 50x returns on the portfolio. Otherwise, the model doesn't work. And
Mhm.
to get that, every one of the companies you fund has to have the potential of getting to that size. Now, everybody knows not every company you fund is going to survive, and even the ones that exit, not everyone's going to exit at that level. But if you start out by building a portfolio of companies that have smaller niche market opportunities, you're doomed from the very beginning because they still going to fail in the same ratio as the companies with bigger, more bold objectives. But when they do sell, the amount of money they bring back is not going to cover the fund, and it's certainly not going to deliver a return. So it took me a
Mhm.
few years to kind of like adjust and reassess, and then yes, looking back, some of the biggest returns in my portfolios are from those outliers. And a couple of those outliers brought back all of the money I invested, as well as some in the case where I was managing funds that brought back all of the investors money, and it actually made a pretty handsome return. And we're talking about maybe five companies out of like 63 companies I invested in. Now, there were other exits as well, and there's nothing wrong about a 2x or a 3x exit. But on a
Mhm.
macro scale, you need that 15x, 30x, 50x exits to really make a mark.
Got it. Yeah, the big home runs is what you need, a couple of those.
Right. So that so market size. Another one is scalability, and that's kind of again tied to this whole idea that you need a holy grail. You need a really big home run at exit to make the model work. And if a company grows in a consistent but slow manner, if it lacks hyper growth or potential for hyper growth, again, it's not a venture fundable opportunity.
Hmm. Might be a good company, but not a venture fundable opportunity.
Absolutely. It could be a great company to start, maybe raise some friends and family money. And again, there are examples like that, right? I mean, there are examples like that. But that's not the kind of company that's going to get you funded. And I think that the biggest problem for entrepreneurs who are a little further along is getting trapped in the middle. I kind of call it the mid stage trap. And the mid stage trap is you're successful at raising your seed round, you're successful at raising your A round, but you lack the kind of hyper growth to really continue raising at the mid stage. And you also don't cut your burn and you don't accept the fact that you should just basically control your expenses, maybe scale down the burn, survive, build a sustainable business, and then exit it. And you continue to burn and try to raise money. And then oftentimes that's a situation where either the company flames out completely and shuts down, or which also happens, it is somewhat successful at raising money, but when it does exit, the multiples are low, and so the founders get severely diluted, and basically it was from a financial standpoint it was an exercise in futility. So again, if you see that your company is not really the type of company that can benefit from increased burn rate, spending a lot on marketing and sales, spending a lot on getting your pipeline of clients, wide. If it's not going to get you to that sort of holy grail of like 10% month over month growth in the early years,
Hmm.
then you should reassess, is venture capital the right model for you?
Okay, so let's talk about the purpose and typical size of seed rounds. What are you typically looking for when raising a seed?
Yeah, no, wonderful. So from what I see in the market, when you're raising a seed, you're typically looking for again that 1 year to 1.5 year worth of runway that's gonna get you to a product market fit.
Hmm.
And by product market fit, I mean that you've got a minimum viable product already. You've got an MVP. That's what you spend your friends and family or pre-seed money on.
Hmm.
You've
Hmm.
tested a couple of hypotheses. You generally understand where to go in terms of your product market fit, and then you raise the money to refine your hypothesis further, find the product market fit, find the sales channel and processes that work for you, understand the
Hmm.
metrics and the cost structure, if especially if it's a software as a service business, right? Understand what's your customer acquisition cost, what's your long-term value of a customer, what's your churn, what channels are the most expensive, what channels are the least expensive, and basically do that so that when you approach a Series A stage, you know exactly where to put the pedal to the metal, where to pour the money from your Series
Hmm.
A to then focus on the financial performance and grow the, annual recurring revenue further and basically kind of like, progress to the next milestone.
Hmm.
Um, in terms of amounts, I mean, it really depends. I would say that probably what I'm seeing nowadays, again, mostly focusing on software, your typical seed round is anywhere from 1 million to on the high end 5 million, but that's like an outlier. Most of the seed
Hmm.
rounds I've seen are in that 1 to 3 million range.
Got it. Well, that's what I have written down right here in the notes. So I think you're right on the mark. Um, yeah. Cool. So there's all sorts of types of startups, like consumer, software as a service, deep tech, and there's more and more all the time. I'm wondering, Are the milestones different across the board for those different types of startups when it comes to when you're raising your seed round, when you raise Series A? Is it different or is it mostly the same across the board?
Right. Yeah. I mean, I think the exact precise milestones are different because they depend really on the industry, right? On the kind of
Hmm.
business it is. So if you're looking at a digital health company, it's going to have different expectations in terms of milestones and perhaps even revenue than if you're
Hmm.
looking at like a mobile app company, like a consumer app company, right? And
Mm,
that's
sure.
going to be different if you're looking like at a deep tech or robotics company. I
Hmm.
think conceptually, the conceptual expectation is the same that by the time you raise seed, you got to have a minimum viable product in hand. You got to have a complete team, and I mean, complete team in terms of the technical founder and the business founder at least, and you got to have some good ideas and hypotheses that are worth testing. Now, in terms of the revenue expected, that's where I think there's a lot of deviation based on what type of company it is.
Got it. So, take into consideration the team, into consideration the type of product. How much traction is really needed when you're raising a seed round? I know you said you need a minimum viable product among other things, but as far as traction, what do you need?
Let's take an example of a software as a service company, right? So, from what I see in the market, and again, there are outliers both ways, but typically, if you're raising a seed round, you want to be in a 20 to 30K MRR, monthly recurring revenue band,
Hmm.
to successfully raise a seed round. Now, I've seen companies with no revenue raise seed rounds. I've seen companies that had much higher revenue, but maybe had some other issues, raise the seed round versus trying to go for Series A right away. But I think that sweet spot is you're at about 20 to 30K. You're growing fast. You're showing at least 10% month over month growth, and that's when you go out and you get your seed round. Maybe you raise your 2.5 million, and then boom, a year later you're closer to a 1 million annual recurring revenue. You're in good shape for Series A. You've validated a lot of your assumptions. You've got a clear path forward to the next stage.
Got it. Okay, next question. I want to ask about convertible notes. So, seed rounds are they're often structured as convertible notes or safes. What are the pros and cons of using these versus price equity rounds?
Yeah, sure, sure. So seed rounds, almost all of the ones I see are the ones I've participated in. They're structured in either convertible notes, or for Silicon Valley companies, it's very common to use safes. So I think that there are a couple of there are a couple of advantages in using them versus doing a priced round if you're an entrepreneur. I think one is the speed of execution. So basically, it's easier and cheaper from a legal fees standpoint to get a convertible note or a safe drafted, distributed to 10 investors, and basically close quickly. If you're doing a price round, there are more terms involved. You're negotiating more things like liquidation preferences, board composition, veto rights, etc. So basically, it's just it's more expensive. It takes longer. The number two advantage is it's easy to do what's called a rolling close with convertible notes or safes, which means that you accept the money from each individual investor as you sign them up. You don't have to wait for a closing and where everybody closes at the same time. With the priced equity round, it's more common to do one or multiple closings, but you typically close a few investors or like a critical mass of the money at the same time, and there you can have a situation where somebody is lagging and then your entire closing is delayed. Last but not least, some founders just feel more comfortable doing convertible notes or safes because they feel that way they're not a setting like a hard valuation of the company at an early stage and doing it with investors that might not be as um, proficient in their field as the future VCs that might come in at Series A stage. So that's one, and that's important because even the conversion cap that you have in a note is safe. I mean, those are easier to set than try to negotiate like the exact valuation of the company. And number two, with priced equity, oftentimes there is an expectation that at least one representative of the investors will be on your board of directors. At seed stage, oftentimes the board is very informal. It's really just the founders. Oftentimes there's little formality to it. And so also entrepreneurs don't really feel like they want to, they want to bring in outside directors at that point in time.
Got it. Lots of reasons to use those convertible notes.
Yeah, absolutely. And it caught on. I mean, I think the Series Seed preferred. I mean, I see them being used sometimes, definitely.
Mm-hmm.
I've invested in a few priced rounds at seed stage. Nothing wrong with those, but not used very commonly at seed stage.
Got it. So earlier you mentioned messy cap tables as a possible red flag. How can messy cap tables with stack notes and safes derail an A round?
Yeah, no, great question. So, and this is what I think I've seen actually quite a few times. There is this phenomena that happens every once in a while where a company it really delays its A round for a while for various reasons. Sometimes it's actually deliberate. They just feel like they want to grow more and they want to raise institutional money at a higher valuation or maybe give up less control. And so I've seen this a few times in my career where you see a company that's gone through multiple rounds of convertible debt, right? At different valuations, and then you got to go out and convert all of that at this A round. And a couple of things to watch out for. I mean, one common red flag is just poor record keeping on part of the company. I mean, this sounds really mundane, but I've been in situations where the company, in due diligence, had to come back three different times and present like three different versions of the cap table because they kept forgetting some early, convertible note investors. There were some duplicate notes, signed. It was just like a mess. So, one piece of advice is, institute good record keeping. Like use something like Carta, perhaps, like a software for keeping your cap table and all of your financing documents in place. Work closely with your attorney or paralegal. I mean, just do it yourself, but basically have very solid record keeping. Another one is too much dilution. Sometimes in the same situation where a company delays the A round, it's easy to let the numbers sleep, and basically by the time you're converting, you sometimes the entrepreneur doesn't realize how much they got diluted because a convertible note it's easy to close, and they just keep on raising and they keep on closing, and then 3 years later, let's say 4 years later, in one case they decide to do an A round, and then it doesn't quite work because with the typical A round valuation, the founders would be diluted to a point that's not comfortable for the A round investors. So that's another one is, watch out because all of that convertible debt or all of those safes you're putting on the books, it's going to convert. It's going to dilute all of the shareholders sooner or later. So, always a good idea to model it out and model it ahead of time and be cognizant of what all of that outstanding, notes or safes, what do they mean to your cap table, assuming like a standard kind of like market average Series A happening.
Mhm. Got it. Why is it important for investors to get large enough ownership?
So it's important for me as an investor to get large enough ownership because again, the venture capital model only works if I hit a couple of home runs, and
Mm-hmm.
at the time that I hit a home run, I own a significant enough percentage to drive a meaningful return. So that's, for example, why when you're a smaller angel investor, you typically gravitate towards early stage deals. I mean, late stage deals might be less risky, But if you put in, let's say, like a typical 30K angel investment into a late stage company, it exits 2 years later, and you make 2x on your 30K. The 2x is like 60K. If you
Mhm.
put 30K into the next Google, and then when it IPOs, you get back 200x. I mean, that's a different. The math is different, right? You're getting like 600K before tax. So same. So for any investor, you got to put in. You basically, if it's a fund, the math is even more complicated because when you run a fund, you have a model of how much money you have under management. Typically, some of that money will go into what's called, uh, uh, or, like direct investments, or basically original investments. Some of it is
Mhm.
getting reserved for what are called follow-ons. Follow-ons are basically investments in companies you've already funded that you really believe in, and so you want to keep investing pro rata to maintain and maybe even increase your percentage ownership. So when you have a model for a fund and you know that, okay, I've got 100 million, I'm gonna do 40 investments of 2 million each on average. So that's 80 million. I'm gonna keep 20 million for follow-ons and let's say 10 companies that really make it. You know that to deploy into 40 companies, you got to deploy an average of 2 million per company. So,
Mhm.
and you need to have a significant enough percentage for that 2 million, where upon exit, it's meaningful. So that's why you oftentimes get people, again, depending on how much they invest per their average check and the stage, but you do get it from investors that, look, I'm happy to do this deal, but it's too small for me, or I'm happy
Mhm.
to do this deal, but I got to take, the majority of the deal. So you do get a lot of that term sheet negotiation because it is important for the investor that the investment works with the overall model for that investor.
Got it. And what kind of range of equity are investors really looking for there? How big of a slice of the cap table are they looking for that's large enough?
Sure, sure. So again, a lot of the stuff deviates up or down, but for the most part, the average on the market is when you raise your seed round, you typically give up anywhere between 20 and 30%.
Hmm.
Uh, when you raise your, and that's like kind of like a standard outcome. When you
Hmm.
raise your A round, you typically give up anywhere from 20 to 40%, again depending on the
Hmm.
size of the round, also how that, what the valuation of the company is, etc. But then the good news is as you go to Series B and beyond, because you're typically raising less money, or less money and at
Hmm.
higher valuations, or even if you raise more money but the valuation is significantly higher, typically the dilution gets cut almost in half. So like it's not unusual to only sell 10% of your company at Series B. It's not unusual for some super late stages to sell 5% or 7% of your company for like tens of millions of dollars, assuming your valuation is high enough at that point.
Got it. Okay, well, we mentioned coronavirus once, but I'd really like to dive into the effects of coronavirus on investing and seed investing. So, how do you think like shelter in place is going to affect closing deals over Zoom typically?
Yeah. Yeah. Well, yeah. No, I mean, I think we're learning. Really, we're learning about that as we go on. Because I'll tell you this: the probably March and most of April, at least for me, was a time where I wasn't making any new investments. I was entirely focused on working with my existing portfolio companies, doing some advisory, for work for them, triaging. We did a couple of bridge rounds for existing companies, etc. I think that the first new deal I've done was actually in early June, and it was a deal that was entirely remote. I've interviewed the founders over Zoom. Everything was done electronically, which is that part is regular. That part was done for a long time, even before COVID. The fact that you close through like electronic signatures and you do your diligence remotely. But it always used to be the case that you wanted to meet the founders at least once, sometimes, twice or a couple of times in person. That part is not really available now, but I do think that, especially at the early stage where the checks are smaller,
Hmm.
I think there's, the deal activity is coming back somewhat.
Yeah, it's interesting. Like video conferencing is not really a replacement for the face to face, huh?
Yeah, it's not really a replacement to face because, I mean, from my standpoint, especially, and I think it would affect funds writing larger checks, even at seed stage.
Hmm.
Like I find it hard to believe somebody's going to write like a 500,000 check for like a seed financing without, really getting into the same physical space with the founders.
At that point, it could still be like a rich rich prince in the Middle East asking for oil money or something. Like.
And I can't see people writing, 10, 15, $30,000 checks on the strengths of like an introduction by somebody they trust and, like a Zoom conference, etc. I mean, that's a different ball game. But I think for institutional guys, like me, I mean, writing that, 300, 500K, I mean, doing that wire, yeah, I really got to see the founders. I got to see how they interact. I like to
Mhm.
see them in a social setting, like, like going to lunch or dinner together.
Mhm.
If it's a bigger involvement, like if they want me to lead the financing, I kind of
Mhm.
like to spend a couple hours at their office, see what the dynamic is. A
Right.
lot of those things, they're intangible, but they're very valuable, and you can't do them through Zoom, right?
You're right, and you're not investing in. I mean, you're not just investing in the product. You're investing in the founders. You're investing in the leadership. You're investing in those relationships. So, kind of hard to do when you're uh, all virtual. But yeah, that. Thanks for answering that. Let's switch gears and go back to raising series. So next, let's talk about Series A rounds. And I'm going to ask you the same question that I asked about seed funding. What's the purpose and typical size you're looking for when raising a Series A?
So I think with a Series A, basically there's three components: product market fit, revenue metrics, and metrics in general, and growth. And you're really going to have all three components to raise a successful Series A. So, starting with product market fit, you know, you can't really raise a Series A if you approach the investors and you're still looking for that product market fit. You're still testing your assumptions on what the product is, who your customer is, what are your sales channels, what's your market. If you're still figuring all of that stuff out, you're too early for a Series A,
Hmm.
right? So you should probably do like a bridge or an extension, answer all those questions, get that together, then go for a Series A. So that's product market fit. In terms of metrics, yeah, you really got to understand that, if you're still at that, if you went from, if it's a year and you went from 20K a month to, 30K a month, you're too early for Series A, and frankly, maybe this is not a venture fundable, company, because maybe the kind of growth you can get to is not what the VCs are looking for. So
Hmm.
your metrics, right? You want to be at that $1 million ARR or close to it. You want to have positive ratio in terms of customer acquisition cost and long-term value. Ideally, you got to have a payback of less than 6 months for your customer. If we talk about most SaaS verticals,
Hmm.
you want to show low churn. You want to show automated sales channels, meaning that it's not the founder doing all the sales by him or herself. Like you actually have a team, you have a process, and uh, last but not least, you really gotta you know you really gotta show the growth, because oftentimes what happens too is sometimes companies that can't raise a Series A, they have that 700K MRR maybe, they have happy customers, they tend to figure out who their customer is and how to sell to that customer, but they can't scale sales. And so if you're looking at a company that early is not really growing, I mean, it's a huge red flag to investors.
Got it. Say your metrics aren't that impressive. Is there anything you can do when you're raising a Series A to kind of improve your chances?
There's a couple of things. I mean, again, fundraising is a game, right? And there's always variables in a game. And
Mm-hmm.
if you understand how the game works and what are the rules, then you can
Mm-hmm.
play. And sometimes you can kind of use the rules to your advantage.
Mm-hmm.
So if your metrics are not that impressive, what can you do? So maybe your metrics are not that impressive, but you have some really high quality marquee clients. Use that to your advantage. Maybe
Mm-hmm.
your metrics are not that impressive, but you have like very good logical explanation of why that is. For example, like, oh, we just got hit by the lockdown,
Right.
or our metrics are not that impressive right now, but perhaps we have this pipeline of signed contracts that are going to be generating a lot more revenue, next quarter. Or frankly, you got to reassess. One of the things we haven't talked about is who is your investor, because not all investors are created equal. So
Mm-hmm.
a deal that may be a subpar deal to a top tier VC may be a wonderful deal to a regional VC or a second or third tier VC or somebody sitting overseas, right? So
Mm-hmm.
again, not all deals are created equal. I mean, that's just the reality.
Mm-hmm.
So if you've got subpar metrics and you can't get traction raising from Silicon Valley VCs, well, maybe you should expand your reach. Maybe you should go talk to angel groups. Maybe you should talk to VCs who are overseas and trying to get into Silicon Valley. Typically, those type of investors don't have the kind of deal flow to get into the most coveted, the most sought after deals. And so,
Mm-hmm.
by definition, they want to do deals. They want to, and sometimes they get into deals that may have been the ugly ducklings early on, but then actually worked out very well. And so, yeah, just expand your reach. That's the kind of advice I give, because venture capital is concentrated on Sand Hill Road, but it doesn't end on Sand Hill Road. There is still that other universe of investors that may be the right fit for your company.
Right. Angel Near listeners, there are places outside of Sandhill Road, just a reminder. Okay, so yeah, definitely there's more than one way to skin a cat. If you're trying to raise money, play the game, figure out what else you can do. Next, I understand that it's possible to raise a Series A without ever raising a seed fund. What are the pros and cons of doing that?
Yeah, I mean that's possible. That's very true. So the pros I think are pretty obvious. Less dilution, right? More equity for the founders.
Mm,
Sometimes they're further along. So there's examples of companies growing organically and then raising a Series A at the pretty high valuation because they did it when they already had like a few $1 million in in annual revenue, etc. What are the cons? Well, one of the cons I've seen is sometimes when you grow organically, there's a couple of cons. There's like I guess two cons that come to mind. One is that when you grow organically, sometimes you sacrifice faster growth because you don't have the money to fuel growth, and so you're more frugal, and as a result, you may not grow as fast. Another one is that you may not be able to innovate as quickly because again you're conserving resources, and you may
mm,
focus more on the immediate revenue generation and controlling burn rate versus on expanding and perfecting the product. um, so I've seen a couple of situations actually when the company didn't raise a Series A, and the root of the problem was because instead of raising seed round, they decided to grow organically. And what happened was they did grow and they had a nice business going, but either the market shifted in the meantime, so they were kind of like too late to the party because
mm,
their competitors raised money and were able to grow and innovate faster, or just the kind of growth rates that they were showing weren't quite enough. But I think if you do skip the seed and you raise the A, then I mean you don't have that problem, and really you get some good benefits. And I think the only other con is when you raise money at the seed stage, especially if you're a first time founder. you get
Hmm.
used to reporting to investors, doing monthly reports, managing investor expectations, clear communications,
Hmm.
managing your company in a more transparent manner, more formal manner. There's a increased sense of responsibility to other outside investors. And you kind of go through it and you get used to it by the time you get to Series A, and there is even more like reporting and board structure and investor meetings, et cetera, et cetera. So maybe sometimes the con is you didn't have all that experience, and then like you're thrown into the Series A scenario, and there might be friction with your Series A investors because the company is just not set up for that type of reporting and that type of transparency.
Hmm. All things to consider. Interesting. What are some common mistakes you've seen by startups trying to raise a Series A?
Yeah. Oh, yeah. I mean, there's a lot of different type of mistakes. Again, I think it all starts with not doing your homework, not doing your research.
Uh huh.
So, for example, trying to raise your Series A and the very basic one, not comparing your metrics and your stage of the company to what a typical Series A investor expects. That's kind of like mistake number one. Being too early, for example. Mistake number two is not having a fundraising strategy, right? Basically, trying to raise it ad hoc. And what
Mm-hmm.
typically happens is, a founder talks to maybe 10 random investors that they happen to know. 10 investors say no. The founder gets discouraged, and it all ends there. I mean, to raise an A round, and I'm not exaggerating, I mean, as an investment banker, at Jaguar Capital, where we have an investment banking arm, and then we also do direct investments. But like in the investment banking arm, we probably close, 7 to 10 deals a year. And I'm not exaggerating. Sometimes to close a Series A for a good client, but sort of like an average client, right? Like they're good company, good metrics, not hitting it completely out of the stadium, but good solid metrics. Sometimes we're going to talk to something like 200 Series A investors to
Hmm.
get 20 investors to express an interest in talking to the founders, really diving in, maybe another 10 due diligence, and then maybe another 3 to 5 commit and actually fund the company. So I
Geez.
think,
So from that 200, you're filtering it down to three or five.
yeah, exactly. So from 200 filtering to 3 or 5, and I think that's a misconception that oftentimes founders just don't have a plan and a strategy, and they don't really understand like the mechanics of, sometimes it's a numbers game. You gotta build a funnel that's wide enough so that you can trickle down to that 3 to 5 investors that will do your Series A.
Yeah. Got it. Wow. Whole lot of talking. Okay, so something you talked about earlier that you wanted to talk about a little bit more, I think, was the investor opportunity fit, how the investor fits in with the company they're investing in. Do you think that this could be more important than metrics or terms for the deal?
Yeah, I think that's very important both ways to understand, do the research, ask pointed questions, be authentic, and
Hmm.
really find out, how investors operate. Because there is, a lot of different approaches out there. Some investors are very hands-on, very aggressive, and frankly have a reputation of like, tough love. If the CEO is not performing the milestones, they've got a game book, and the game plays replace the CEO, right? Get the founder away from the CEO position, put in a new CEO. Some investors are very founder friendly and they tend to be more passive. Like a corporate investor is probably more interested in the status of the technology and a potential licensing or collaboration deal than they necessarily interested in the financial metrics, like in the revenue. So if you're raising
Hmm.
money from corporate investor, they might cut you more slack when it comes down to your revenue. If you're
Hmm.
raising money from an investor who is super focused on revenue, it's going to be a different ball game. So
Hmm.
yeah, so I would, if you're raising money from investors that may be perceived as high risk by the overall community in the U.S., like the other investment community, you probably shouldn't do it. So there is, I mean, geopolitics, right? I mean, It's not illegal unless they're on the sanctions list, but it's not illegal per se, for example, to take money from Chinese funds or Russian funds or some other jurisdictions. But the reality is that might really complicate your fundraising downstream. So again, I think there's the strategy, and the universe has evolved so much, and there is
Mhm.
so much money, more money on the market than, let's say, in the 90s or even like the 2000s, that it really does require a strategy and a preparation. Because I think the days of a founder going to 10 pitch meetings and then getting three term sheets, I mean, those things happen, but they typically happen when you're really completely, like, the company is just amazing, or the founder had multiple big ticket exits before, or your growth rates are just completely out of this world. But that's an outlier. The more
Mhm.
typical situation is, even successful companies, you get like 200 people to say no to get the five people to say yes.
Mhm. Got it. So I think my main takeaway from this conversation for founders and CEOs is going to be do your due diligence, start early because this environment has evolved, this universe, like you said, it's every other player is doing their due diligence. So for the founders, you got to do that too. Before we get out of here, do you have any parting advice for founders? I know we got into a lot of detail, but do you have anything final you'd like to say?
No, I just, again, thank you for this opportunity. I just want to say that never get discouraged. I think there's so much opportunity out there. There's so many investors.
Mhm.
Deals do happen. Once earlier in my career, when I was a venture backed entrepreneur, it
Mhm.
actually took 2 years doing the project, nights and weekends, keeping our day jobs, pitching in whatever we could, and basically self funding. It took us 2 years to raise a Series A. We started the company in 2008 in the midst of the financial crisis, and it wasn't like 2010, right, when things started to normalize, that we were able to raise the A, and then ultimately we sold that company. But yeah, just don't get discouraged, and have a strategy in mind, because that's a big part to successfully raising a seed or an A round, is having a strategy.
Mhm. Great advice. All right, Julian, thanks for doing this. Before we go, what's the best way for our listeners to reach you?
Absolutely. So I'm on LinkedIn. My email is very easily accessed by just searching my name, Julian Zegelman. You're
Mhm.
also welcome to our website. It's www.jaguarcapital.io, and there's a link to my email and my LinkedIn profile there as well. So I'm happy to speak with any engineers and engineer listeners and see if I can be helpful.
All right. Well, thanks for joining us, Julian. I definitely learned a lot about seed funding and Series A. Listeners, if you have any questions, please send us email at info@angelnears.com. Julian, thanks for joining the show today. We'd love to have you on here again soon.
Perfect. Thank you so much. Thank you, Oleg.